Hello everyone, this is Andrew McNair from Swan Capital with our May 2024 Swan Report. In this month's video, we're going to discuss some recent headlines that have happened in the financial markets that are influencing the economy. But I also want to provide you some perspective on what all of these developments may mean for your actual retirement portfolio. And I want you to have this tangible information that you can use over the next few months ahead. Now, as always, please stay tuned at the end of this video for a required disclosure statement. Now, at Swan Capital, our market outlook remains cautious because of world conflicts, higher consumer credit, coupled with higher interest rates. If you look at the thermometers that we look at, looking at if the economy or if the stock market is overpriced, look no further than the Buffett indicator that is at 2 standard deviations. Look at the Shiller PE ratio that last time I checked it was at 34. This is why at Swan Capital we are starting to downshift and prepare for any market volatility that may lie ahead for the rest of 2024. Now, as we have navigated through May, the market's expectations for interest rate cuts remained low, reflecting a Federal Reserve intent on maintaining current rates amidst rising inflation. And we are nowhere near the targeted 2% that the Fed would like to see before considering rate cuts. Yet the market wants to see these rate cuts. In reality, we've actually trended higher in recent months. Driving inflation down from 3.5% to 2% will take a long time to achieve. And I don't think that people have long-term expectations on their interest rates. We want it changed and fixed right away. But this is not a microwave kind of situation. It's going to take time. Rushing to drive inflation down to 2% via further Fed rate hikes would lead to a recession. And no one wants that. No one is up for that. The Fed funds futures are currently saying that we have about 70% of a chance of a rate cut in September and another in December or November. Again, I think that is wishful thinking in my personal opinion. But after what we've seen in the first 4 months of the year, that prediction of a possible November rate cut, into my opinion, is almost laughable and utterly useless. The only good news is that the market seems to have woken up to the possibility of no rate cuts this year and has really hung in there despite losing those rate cuts that they were hoping for. So when we actually get a cut, it could push the markets forward. Now, I do want to take a deep dive into the jobs reports that have come out. The Job Openings and Labor Turnover Summary, or JOLTS. This report for March came in at 8.49 million job openings. That's the lowest number in 3 years, and it was lower than estimated. Now, quit rates have eased, which is something we want to keep a close eye on, and hiring continues at a lower rate. The ADP employment number was stronger than expected for the corporate side. We've added 192,000 jobs versus a consensus of 175,000 jobs. Now, if we look at the ADP's report, it covers more than 500,000 companies, totaling more than 25 million employees. I'm talking, this is a big sample size. We finally caught a break, though, from the string of negative inflation readings. The BLS report, the Bureau of Labor Statistics, it looks at non-farm payrolls. It read 175,000 jobs, well below the consensus of 243,000 jobs. So very conflicting information we're getting. Now, if we look at unemployment, it ticked up to 3.9% from 3.8%. And wage growth actually slowed more than expected, while hours worked also declined from the prior month. So February's payroll numbers was revised down from 270,000 to 236,000. So the weaker jobs numbers reaffirm that the Fed will not have a reason to raise rates. Plus, with the unemployment rate creeping toward the psychologically important 4% threshold, markets will begin to start to buzz about the Fed having to do something about its second mandate, which is full employment. So far, the Fed has really had all of its focus primarily focused on the first of its dual mandates, which is price stability or inflation. If jobs start to dry up, though, markets will figure that the Fed will need to pivot and cut rates to keep the jobs market healthy. Now, given the Fed's posture of waiting on data before committing, which is a good idea, by the way, we would need to see several more months of steady declines in the jobs market. Now, the concern is that just like the Fed was late to the inflation game, so too it may be late to bolster jobs before we see a slide towards a recession. Now, in other news, this is really interesting. The Federal Trade Committee voted for a new ban on non-compete agreements. And this is huge, taking place as soon as August. And this is why I personally believe we've given too much power to these three-letter agencies, because the FTC believes the ban will protect employees' ability to find work and argues that companies may use other means to prevent the spill of trade secrets. Now, this new ban has caused plenty of pushback. Business groups are filing lawsuits after lawsuits to challenge the FTC's ability to ban non-competes. For market innovation, though, the ban is projected to generate an increase in patent filings and encourage startup activity. It could potentially lead to a 2.7% rise in new business formations, equating to 8,500 new companies each year. However, America is all about protecting. It has a long history of protecting those patents and trade secrets that I would hate to see go by the wayside. This new rule may strengthen the U.S. entrepreneurial economy and could change the competitive landscape of large businesses versus small corporations and small businesses. Now, if you're confused about the current state of the economy, you're definitely not alone. This data that we're sharing with you seems really puzzling and conflicting. And that's why at Swan Capital, we help distill this information so that it's actionable for our clients. At Swan Capital, we have started switching portfolios for all of our clients' accounts other than their taxable accounts and downshifting them to lower risk portfolios. Why? Because we want to get prepared for any market pullbacks, because again, the alarms are going off for the Buffett indicator and the Shiller index. I think it's a really good time as a retiree to always remember reverse dollar cost averaging works against you. If you start taking money out of the market while the market's down, that money never recovers. So this is not a time to dollar cost average so much as it is a time to do the opposite, to start taking money out at market highs as it continues to hit these market highs and lowering down your allocations to something more conservative. You just need to make sure that you consider the tax implications of any such moves if you're in a taxable account. If you have questions about your 401k, your portfolio, and you want to know what to do about it, that's exactly why we have 101 meetings with families every day. That's going to be it for this month's Swan Report. I want to thank you for listening every month. I know many of you do. Now, please remember that nothing we talk about here is a recommendation for you specifically. But if you need recommendations about your personal financial situation, do give us a call at 1-800-848-8768, and we'd be happy to talk to you. See you next month.